Hi, Michael Yarden here, and today I'd like to have a bit of a chat about, is it a bad time to buy in the property market at the moment, and also how important is getting the timing right in the property market at the moment. This masterclass will last 20 minutes, but there's lots of information I want to give you because I guess one of the most common questions I'm getting at the moment is, should I be buying? Should I not? Should I be selling? What's going on? And maybe I should wait because I'm a bit concerned that the property market is going to go down a bit further. Well, let's first of all get things clear. There's not one property market in Australia, so there's multiple markets around Australia. But what I'd like to share with you today is some research that Metropole has just done that will explain to you how important or not timing is, what would have happened if you would have had your crystal ball right and chosen the best time or the worst times in the market in previous downturns. And I'm going to give you some lessons to learn from that. So at the end of this session, you're going to be a more informed property investor and you're going to know what you should be doing depending upon your own personal situation. Now, with the news of house prices falling and the prospect of further falls ahead, I can understand why property investors are nervous. I understand why they're thinking the way they're thinking. No one wants to buy near the top of the market and see the value of their properties fall, and then they're waiting a couple of years for the market to rise again. You know, it's often said that timing is everything when it comes to property. And let me let you into a little secret. That's not really the case. When I first started investing, I understood very little about market cycles. And yet I made some great investments. And then I learned the concept of counter-cyclical investing. You can see the chart on the screen at the moment that shows you how property cycles work. While property values rise in the long term, the market sways. There are periods when it's flat, then there's an upturn phase, then the boom phase, which we experienced in Melbourne and Sydney until 2017. Then it remains flat again, and sometimes property values fall. And that's happening around Australia. But there are different cycles. Different states are at different stages of the cycle, and then within each state, there's multiple cycles depending upon geography, price point, and the type of property as well. So I didn't understand all this when I first started investing. And then I learned the concept of counter-cyclical investing. I was told that smart investors aim to acquire their assets counter-cyclically. In other words, they follow Warren Buffett's advice. They've been taught to be fearful when others are greedy and greedy when others are fearful. I read in my early days that understanding the cyclical nature of the property market and the relationship between the different stages of the cycle was important. It actually helped you maximize your returns while at the same time exposing you to minimum risk. And that made sense to me at the time. If you knew where things were heading and you could buy before the crowds were, before prices started rising strongly, it was likely you were going to make big profits. That all made sense over the time. But in time, I actually learned that that wasn't always the case. In fact, if you wait for the right opportunity counter-cyclically, you'll often be left behind. So I'm no longer a big believer in counter-cyclical investing because I realized that timing is one of the most misunderstood concepts with regard to investing. The truth is, successful investors, they know how to make money at any point in the property cycle. Timing definitely matters, but successful investors find that timing really isn't that important to them. I don't know if you've noticed how some investors seem to do really well in good times and do even better in bad times. Market timing isn't important to them. On the other hand, others do poorly in good times and even worse in bad times. Market timing doesn't seem to have much effect on them either. Now that's interesting, isn't it? So how important is timing the market? I got the team at Metropole, the research team, to look at Melbourne median house values for the inner ring suburbs of Melbourne, the properties we've been investing in for over 20 years. We looked at this from the statistics from the Real Estate Institute of Australia going back to 1998. And it's interesting, there's a couple of things to notice. First of all, we're experiencing now the fifth downturn over this 20-year period. Now, I'm talking about Melbourne specifically here, but it's the same in all other states in Australia. This is just to illustrate a point. So wouldn't it be interesting to know how much difference it would have made if a property investor managed to buy the right property at the right time of the cycle, at the bottom of the cycle of each of these downturns, as opposed to getting it terribly wrong and buying right at the peak of the cycle. Now you can see there was a downturn in 2000 and September and June 2000. There was another one in 2003. There was the global financial crisis in 2007 and 8. In 2012, there was a bit of a downturn as well. 2010 actually had started when the Reserve Bank raised interest rates because the market was getting ahead of itself. And you can see how there was a lull there, and then the market picked up again. And in 2017, the property market started to slow down again. So I guess I wanted to dig into the figures and see how much of a difference it would make today at if you'd invested at the best and again at the worst of each of those times in the property cycle. Well, this table shows you what I was looking at. If you go to the global financial crisis, let's look at the third line down. What you're going to see there is about 10 years ago, during the global financial crisis, when people were allowed to be worried, they were allowed to be scared because the world was going through unusual times. We'd never had an experience like that since the Great Depression, where countries were going broke, where institutions were going broke. At worst, property markets fell just over 10% in Melbourne. And what happened was the Reserve Bank lowered interest rates and state governments gave first homeowner grants and incentives. So that's one of the reasons I don't believe we're going to have a market crash this time either, by the way, but that's a whole different discussion. But if you bought at the very worst time, as opposed to the very best time, just before properties rose, you would have actually had $74,000 equity extra today. And that's the equity, the value of the properties had gone down in that time. But today, 10 years later, it would have made less than 2% difference in all your capital growth. If you'd gone back to 2000 and the property market fell close to 7% then, the difference in your compound capital growth today would be less than about 0.5%. The difference in extra equity you'd have today, if you could have got the market right, was $21,500. So I've drawn a couple of conclusions from this. Firstly, perfect timing has very little impact if you hold your investments over the long term. So the investor who bought at the very worst time in 2000 is, as I said, only $21,000 or 0.58% worse off than the investor who got the timing right, buying right at the very bottom of the cycle. In fact, the difference is statistically irrelevant if you hold your properties over the long term, say 20 years. Even investors who bought during the global financial crisis are only 1.9% worse off if they'd have bought just before the property market started to pick up in 2008, and that's when the Reserve Bank dropped interest rates to stimulate the market. Of course, if our hypothetical investor had held off buying while waiting for that ideal time to get in the property market during the global financial crisis, it's really unlikely that they would have bought at that perfect time, and they've been waiting for other market signals that the property market had moved on to the next phase. They wouldn't have been smart enough or able to buy in advance. Of course, all these factors would have come to light long after the property market had bottomed, when auction clearance rate rose and other investors moved into the market. So the first lesson to get from all this is perfect timing has got very little impact if you hold your investments over the long term. The next lesson I got out of this is owning the right assets is critical. Look, the property market's very forgiving. The longer you hold a property investment, the less important perfect timing becomes. More important than timing is the quality of the asset you own, because investment-grade properties are going to outperform the averages with regard to capital growth. And the graph you're showing on the screen at the moment shows how much different a slight increase in improvement in capital growth gives you. So currently, many would-be investors are holding off. They're waiting for their timing to be just right. They're trying to see if the market's going to bottom. But my experience is that procrastinating now means you're highly unlikely to be able to pick the bottom, as I was saying before. Because when the market turns, those investors who are holding on, waiting for the things to be right, they're sitting in the sidelines at the moment, are still going to be waiting for the right signals and most likely be worse off than those who made a poorly timed decision but took action and bought the right property. So the graph that you're looking at shows if you own the right property, one that grows at wealth-producing rates of return over the long term, then your asset base is going to grow substantially more, and over time that's going to give you the cash flow to develop the financial freedom you want. So correct asset selection is much more important than trying to time the market. But that brings us to the next point. If you want to become wealthy, you're going to need to understand the power of compounding. Look, it's the very root of making money work for you, and happens when you let the earnings of an investment compound instead of withdrawing them and spending more. Look, think about it. If you had a term deposit, you put $10,000 into the bank and got, 3% interest. Not that you'd even get that, but at the end of the year, you'd have $300. Now, if you kept it in the account and the next year you'd get interest on $10,300, not just the original $10,000. That is what compounding is, and it keeps building up year after year, and it's much the same with property. So the graph that you can see now shows what would happen if, to the value of a property that you bought, if it compounded at 7% per annum. Now, of course, that's an average growth. It doesn't happen each and every year, but interestingly, our research at Metropole shows that over the last 25 years, Melbourne and Sydney property values on average went up just over 8% per annum, and Brisbane property values went up just over 7% per annum. What that means is that at 7% per annum, properties double in value every 10 years. So while this property on the graph has doubled in 10 years, the power of compounding means that almost half of its increased value over a 15-year period occurs in the last 5 years. So 45% of the capital growth over the 15-year period occurs in 45 years. So once again, what I'm trying to show you is that timing is nowhere near as important as owning the right type of asset and then holding it in the long term. So how do you choose the right asset? What we do is look at location as well as the right property. And this chart is showing you that the majority of the heavy lifting occurs because of the location. Then, of course, you've got to own the right property in that location. To choose the right asset, we first of all have a look at how's the economy going. And Australia's economy is doing pretty nicely. And the Reserve Bank, and interestingly, recently the International Monetary Fund is suggesting that Australia's economy is going to perform even stronger in the next couple of years. And if we've got strong economy, strong population growth, rising wages that are happening a little bit slowly, people are going to come in and they're going to be able to afford houses. There's no crash in sight. So you look for how the economy is going, and then you look for a state that is the right stage of its property cycle. Remember, there's multiple cycles. Each state's at its own stage of the cycle. And while the Melbourne and Sydney market is falling on average, there are some areas in both the Melbourne and Sydney property markets that are holding their values really, really well. But we look for the right state, and then we look for the right suburb in that state, one that's going to outperform the averages. And that has a lot to do with demographics, the people that are living there. We're looking for areas where people's wages are higher, their disposable income is higher, and this is often gentrifying areas or areas where there are professionals. Looking forward, the wages growth in the blue-collar areas and the outer suburbs and the young family suburbs is going to be minimal. People are going to lose their jobs due to technology and robotics and artificial intelligence, but the professionals are less likely to lose their jobs, less likely to have low wages growth, more likely, I guess, to have high wages growth. So we choose the suburbs based on high disposable income. In the last census, there were some suburbs where disposable income grew 50% more than others. Don't you think in those areas people are going to have more money to buy homes, keep homes, improve their homes? Then within the right suburb, we look for the location. You know, in your own suburb, there are areas where you'd buy and where areas where you'd prefer not to live. Different patches, you've got to know that. And then the right property. I guess what I'm showing you is that location's doing 80% of the heavy lifting. And so we choose the right location, and the right property is one that has the characteristics of an investment grade property. It's got strong owner-occupier appeal because investors are going to be out of the market a bit at the moment. It's going to be able to be bought below intrinsic value. It's going to have an element of scarcity to make it always of interest to people. It's going to have a high land to asset ratio. And that's why, other than in Sydney, we're avoiding apartments at the moment. In Sydney, you've got to buy the right sort of apartment, one with a high land to asset ratio, so in a smaller boutique block, but townhouses, villa units, homes have good land to asset ratios. Then we look for something with a twist, something a bit special or different about it. And because the market's not growing much at the moment, my suggestion is you look for property to which you can add value, because adding value to your property is going to help you manufacture growth at a time when the market isn't growing as strongly. And then we look for all the other right characteristics of a property as well. Another lesson to learn is that no one really knows what's going on with the property markets. In Australia, we've got about 25 million property experts. Everyone's got an opinion on property, haven't they? Yet you know what they say about opinions. They're a bit like belly buttons. Everyone's got one, but they're basically useless. Of course, even the property experts tend to get it wrong, despite being armed with all the research available in today's modern information age. The reason is that market movements are far from an exact science. The fundamentals are easy to monitor, things like population growth, supply and demand, employment levels, interest rates, affordability, and inflationary pressures. However, there's one overriding factor that experts just have difficulty in quantifying, and that's investor sentiment. Currently, investor sentiment is low. In fact, it's the lowest it's been for decades, despite our economic fundamentals being quite solid. Our population growth is strong, the economy is doing well, our banking system is sound, everyone who wants a job's got a job. It's really interesting that we have such a crisis of confidence, and it's really related to the media. Unfortunately, even the most rational of us tend to suffer from lapses of logic when dealing with money. And many of our investment decisions are being made based on emotion. Think about it. When the media is full of reports that property prices are crashing and impending house crash and Armageddon, many investors become scared and sit on the sidelines. They think it's the end of property. They think it's the right time to get out of property. They feel property values will never improve. At that stage, though, much of the risk's been removed from the market. Conversely, when the market's booming and stories of investors seemingly making amazing gains overnight keep going in the media, people want to jump on the bandwagon and cash in, but often that's actually the worst time because the market's near its peak. You've heard me often say it before, as supposedly rational beings, humans tend to act very irrationally when it comes to money. There's a few other emotional traps we experience. We become overconfident. We've got wishful thinking. We've got confirmation bias, where we ignore information that conflicts with our current views and look for information that says what we believe is right. In other words, many investors create their own reality, but unfortunately, I've come to realize the crowd is always wrong. When there's a general belief that property values can only keep rising, and this spreads through a whole new generation of investors, as it does each cycle, driven by the fear of missing out, they drive property values up even further, perpetuating the belief and helping make it a reality. Similarly, when the crowd believes the real estate market is going to crash, fear of buying early keeps them out of the market, and their negative sentiment gets reported, and this feeds on itself. So what can property investors learn from all this? Well, first of all, as I said before, there's multiple property markets around Australia at the moment. Some are still growing and others are poised for growth. And some markets, they're still going to slump for a while over the next year or so. So rather than trying to time the market, buy the best assets you can. Timing a property purchase, that's going to give you a one-off bonus. However, owning the right property, an investment grade one that grows at wealth producing rates of return, is going to see your portfolio outperforming over the long term. Another lesson is, at times of poor or no capital growth, strategic property investors manufacture their own capital growth through property renovations and developments. Of course, you've got to remember the lesson that booms never last forever, but neither do busts. So don't be surprised when they come round, but don't overact either. This will help you avoid being sucked into the booms and spat out by the busts. A fifth lesson is that property markets are not just driven by fundamentals, but they're also driven by irrational and erratic behaviour of an unstable crowd of other investors. So while the long-term performance of property is influenced by the fundamentals, its short-term ups and downs are much, much more affected by market sentiment. So treat your property investments like a business and stick to a proven strategy to take the emotions out of your investment. Don't make 30-year investment decisions based on 30 minutes of news. Don't look for what works now in the investment market. Look for what's always worked. So recognize that property investments are long-term play and set up financial buffers to help you ride the property cycle up and down. Have the right finance structures in place, the right ownership structures, and make sure you own the right sort of properties. So what should you do? I don't know. I don't know your personal circumstances, but my team and I'd love to have a chat with you to see if we can help you. So if you're looking for independent advice to help you become financially free, no one can help you more than the team at Metropole. We're independent, we're unbiased, we don't have any properties for sale, and we've been around the block a few times. Many of us have invested for 2 or 3 decades, so we've seen markets like this before. Remember, as I said, we've got no properties for sale, so we're unbiased. We've got our own offices in Melbourne, Sydney and Brisbane. So whether you're a beginning investor or a seasoned professional, why not have a chat with the team at Metropole? We'd love to help you formulate an investment strategy or review your existing property portfolio and help you take your property investment to the next level. So go to metropole.com.au and click on the link there. Find out about what we can do to help you. Have a chat with us. It's obligation free, or call us on 1300 Metropole. And when you attend one of our offices of Metropole, we'll even give you a free copy of one of my books. In fact, you can even choose which one you like. So hopefully now you understand that while market timing is useful, it's not critical. It's more important to own the right assets, stay in the market for the long term, treat your property investments like a business, and have the right finance strategies to see you through. There's going to be lots of headwinds in the next couple of years. There's going to be challenges with finance, with banking, with market sentiment, with the media continuously giving us a continuous conveyor belt of negative messages because it gets clickbait. But I hope you now have a better understanding. That doesn't mean you can buy any property or at any time or anywhere. In my mind, there's only a small percentage of properties on the market that are investment grade. So why not have a chat with the team at Metropole? I look forward to being part of your wealth creation journey.